And then we have the liquidity. We're also talking a lot of times about liquidity. And I think it's also one of the main topics of Kyle, and he explains it very well as well. But for newbies, it can be difficult to understand. It was difficult for me as well. And it's not always very objective. That's the problem. Because once you know what liquidity is, sometimes, let's say, at first you are completely confused by liquidity. Then, if you step over this, you see liquidity everywhere suddenly, which is confusing you again because you're afraid to do anything. Everywhere is liquidity. The price could go everywhere. And once you understood when you have to consider liquidity concepts, everything will get easier. And I draw this liquidity as dollar signs because this is what most traders do, which I follow, is they draw the liquidity as dollar signs as long as it's fresh. So the liquidity has not been taken. You see the dollar signs, and this means there is liquidity waiting. And there's a lot of liquidity scenarios and concepts. I just want to talk about three main concepts because they should cover the main topics, in fact. And again, there's a lot more about it, but here we have a clear uptrend, which you can see. And in this uptrend, it could be internal structure, it could be swing structure, it doesn't matter, but usually it's used with internal structure. You have kind of trend line liquidity. That's what it's called here. And why is this considered trend line liquidity? Because there's a lot of trend line traders out there. And whenever a new low is created, they would put their stops exactly below these lows. And hence, everywhere below these lows, there is waiting liquidity and money. And then we have equal high liquidity and equal low liquidity. And then, of course, there's also something similar like relatively equal high, relatively equal low is when they are not exactly at the same position, but one is a little bit higher, a little bit lower. That's still considered a liquidity, but you have to see which one is higher than the other. Yeah, I think that's the next step we should explain. You can see here the highlighted areas. This is where the stops, from buyers are waiting because they want to protect their buys here below the lows. And I think all of us do it that way, at least have learned it that way. And hence there's a lot of money waiting below all of this. And money is liquidity, and liquidity is needed for the market maker to move the price. And it's the same with the equal highs and equal lows. Traders would sell here for, depending on your trading style, of course, but traders would sell here because they might consider this being resistant. The price was not able to break this line, goes up again, was not able to break this line. Oh, that's a very strong resistance, goes up again. But all it actually wanted to do is to engineer and build liquidity, because there's algorithms behind, there's market makers who do this on purpose because they know what we as retail traders do, and how we trade. And of course, they have other tools where they can have a look how many orders are waiting here, and what's the best direction to move the price to. In fact, oops, with this admit. And it's the same for the equal lows and relatively equal lows. It's engineered liquidity. Now, I don't have for the moment chart examples. It's just for you to understand when we talk about liquidity, what do we mean with it? And if you have a look on Kyle's examples, you will see the liquidity he points out everywhere. And now you should know what he means with liquidity, because this is exactly what usually happens. For the trend line liquidity and the X usually in the charts, the marked up charts, they indicate liquidity has been taken. liquidity has been taken, and here as well, liquidity has been taken. What does that mean? You had an uptrend, internal structure maybe, and you had the stops here, you had the stops here, price suddenly moves lower, breaks this internal low, only to take liquidity, which is waiting here, the money which is waiting here, to move the price higher afterwards, to create a new high. And it's the same here, equal highs, equal lows. They moved it usually to the pip. Sometimes the second one is a little bit lower, which even provides more liquidity because people think that they have a confirmed entry. This low is lower than this one just by a few pips. So of course we have now a downtrend. And this means even more liquidity. If this one would be higher, it actually would have taken out already this liquidity. So if this one is lower, or at least both have the same height, then you can consider there is a lot of liquidity sitting above it, and the price might go up just with a few pips to take out liquidity, usually with a wick only, to be honest, and then make a breaker structure. And that's, by the way, is something, if you see that the price takes out liquidity like here, and then as a next step, break structure, this is now a strong zone you want to have a look at. Liquidity, breaking structure, this is the zone you want to have a look now. Because they took liquidity, they have no interest in going back up here again. They drove the price in one direction, they don't want to go up again usually. And this high is now really considered a protected high because they don't want to break this once more. Everybody here was trapped, taken out, and now, because it's not only sell stops waiting here, or stop losses for sales waiting here, it's also buy stops waiting here for people who consider breakout trading. And those buy stops are now trapped because they triggered it and then they moved away. And it's the same concept here. Yeah, and then there is a saying, don't be the liquidity. So if you understand the concept, because usually we are very often liquidity because we put our stops where market makers and banks want to have the stops. And hence we are very often liquidity. So you should try to prevent to be the liquidity, don't be the liquidity.